Hello students, welcome to EPG Pathsala. I am Amit Kumar Basantrai from Central University of Himachal Pradesh. Today we are going to discuss on the module Consumption and Investment from paper Managerial Economics. After completing this module, the students will be able to learn meaning and definitions of consumption. The students would also understand various theories of consumption, and there are many theories of consumption which talks about or which gives various determinants of consumption, and students should be able to grasp all those determinants, all those factors that affect consumption. The students would also be able to learn the meaning and types of investment, and there are different types of investment depending upon the purposes, and they would be able to distinguish between different types of investment. The students would be able to understand difference between investment and capital, and there is this minute difference between capital and investment. After completing this module, the students would also be able to know the meaning of marginal efficiency of capital and marginal efficiency of investment, or the difference between MEC and MEI. Lastly, the students would be able to learn various theories of investment. So, what do you mean by this variable consumption? Now, we will take up the definition given by World Bank. The World Bank defines consumption expenditure as the sum total of household final consumption expenditure and final government expenditure. So clearly in this consumption expenditure there are two parts. One is household final consumption expenditure and one is the government final expenditure. Household final consumption expenditure, which was formerly known as private consumption, is the market value of all goods and services including durable products. And what are those durable products? Durable products are cars, washing machines and home computers, etc. Now, household final consumption expenditure is the market value of all goods and services including durable products purchased by households. Final government consumption expenditure includes all government current expenditure for purchases of goods and services including compensation of employees. It also includes the most expenditure on national defense and security, but excludes government military expenditures that are part of government capital formation. Consumption is a very important macroeconomic variable as it is determined by the level of national income. And again, the level of national income is also, besides all other variables of course, depends upon the level of consumption expenditure. Entire production sector's demand comes from the consumption expenditure. If you do not consume, the demand for products, demand for producers, those are demand for products that are produced by producers would not be coming forward. So when level of consumption expenditure is low, production would be low, investment would be low, employment would be low, and so on. Therefore, it is said that level of economic activity is largely determined by the overall consumption expenditure. The very significance of this variable needs us to have a very good understanding of the variable itself. And to understand this, we need to know the factors affecting consumption expenditure and the relationship of the variable with these factors. So, what are the different factors that affect consumption expenditure or through which consumption expenditure is determined? And what is the relationship of consumption expenditure with these individual factors? Now, to understand this, a discussion on theories of consumption is needed. In the era of classical economics, consumption expenditure was a function of rate of interest. When rate of interest increased, consumption expenditure decreased and vice versa. John Maynard Keynes differed from this opinion. John Maynard Keynes kind of gave another view on the determinants of consumption. According to J.M. Keynes, which the point of J.M. Keynes on the determinants of consumption expenditure is recorded in General Theory of Employment, Interest in Money, which was published in 1936. Keynes argued that it is the real income that determines consumption expenditure. So, whereas classical economics gave rate of interest to be the determinant of consumption expenditure, Keynes gave us this idea that the real income is the factor that determines consumption expenditure. Since then, there is a general agreement among economics that consumption expenditure is a function of income. But as you know, there are different concepts of income such as absolute income, relative income, current income, future expected income, short run income, long run or permanent income, income over the entire life cycle, and so on. So there are varying natures of income, there are varying types of income. So what is that concept of income on which consumption expenditure depend? There are also other factors than income such as wealth, tax policy of the government, interest rate, particularly on consumer credits, inflation, consumers' expectation on inflation, and income distribution on which consumption expenditures depend. So these different concepts of income and factors other than income have been stated by different economists as the determinants of consumption expenditure, which has given us 5 major theories of consumption. Now let us now discuss one by one these 5 major theories of consumption. The theory of consumption given by John Maynard Keynes is otherwise known as Keynesian theory of consumption, and it follows from the Keynesian consumption function. As you know, consumption function is nothing but a functional relationship between consumption expenditure and its determinants. Keynesian consumption function states that consumption expenditure is a positive function of income, that is, when income rises, consumption expenditure rises and vice versa. This relationship between consumption and income primarily follows from the Keynes' fundamental psychological law of consumption, which states that men are disposed as a rule and an average to increase their consumption as their income increases, but not as much as the increase in their income. In simple words, the fundamental psychological law of consumption means when income of a person goes up from, let's say, Y to delta Y, consumption of that person increases from C to delta C, but not to the proportion of the increase in income. That is, delta C upon delta Y is greater than equal to 0. For example, if income increases by 40%, consumption would increase not by 40 or more than 40%, but by less than 40%, and the exact extent to which consumption would increase depends upon the marginal propensity to consume, or MPC. Now, what is this MPC? The relationship between marginal income and marginal consumption is known as MPC. Symbolically, it can be expressed as delta C upon delta Y, where delta C is marginal consumption or exact increase in consumption from the previous level of consumption, and delta Y is marginal income or exact increase in income from the previous level of income. Keynes said MPC decreases with the increase in income, or when income increases, that means when income increases, people consume a decreasing portion of marginal income. There is another relationship which is called average propensity to consume, or APC. The relationship between income and consumption is known as APC. Symbolically, it is written as C upon Y, where C is consumption and Y is income. In simple words, it states the proportion of income spent on consumption. Keynes' consumption theory states that current consumption expenditure is a function of current and absolute level of income. Hence, consumption C is a function of Y, where Y is the current income and F represents function. Since Keynes believed in the short run, and as we know, Keynes is the one who said in the short run we are all dead, this theory is also known as short run theory of consumption. The main properties of the theory are as follows. First property of this theory is that the real consumption expenditure is a positive function of real current disposable income. C is a function of Y and delta C upon delta Y is greater than 0. Second property of this theory is that MPC lies between 0 and 1, or delta C upon delta Y varies from 0 to 1, or 0 is less than delta C upon delta Y is less than 1. Third property of this theory is MPC is less than APC, or marginal propensity to consumption is less than average propensity to consume. That is, delta C upon delta Y is less than C upon Y. Fourth property of this theory is the MPC declines as the income increases, or the proportion of delta Y that is used for delta C goes on decreasing. Out of the above four properties that we just mentioned, first two are the pillars of the absolute income theory. The last two are rejected by the followers of Keynes due to their notwithstanding of empirical testing. Keynesians hold a position that states APC is equal to MPC. One of the biggest limitations of Keynes' theory was that it did withstand empirical scrutiny. After the Second World War, many economists attempted to design consumption theory on the basis of empirical data, but none succeeded, like Duijsenberry, who gave the relative income hypothesis based on the income consumption data of 1940s, in which he links consumption level of a household with the income and expenditure level of households with more or less same income bracket. In this theory, Duijsenberry used a term demonstration effect, which states that with regard to consumption, a household imitate and compete with the consumption behavior of households with comparable income. If a household with a lower income lives in a colony of households with higher incomes, whose consumption expenditure is high, then the household would spend a higher proportion of its income on consumption by imitating its neighbors. This type of consumer behavior is also known as keeping up with the Joneses. According to relative income theory, consumption expenditure of a household depends on the level of its income in relation to the households with which it identifies itself. By stating that consumption is a function of relative income, it rejects the Keynes idea of consumption depending upon absolute income. The theory of permanent income hypothesis was given by Milton Friedman, whom we consider as father of monetary economics. Milton Friedman rejected the earlier two theories of consumption, that is, Keynesian consumption theory and the consumption theory given by Duijsenberry. According to Milton Friedman, consumption depends on permanent income, not current income. In this theory, consumption is a function of permanent income. That is, C is a function of YP, where C is consumption, YP is permanent income, and this relationship is a proportional relationship. Now the next question is, what is this permanent income and how is it different from current income? Simply put, permanent income is the income about which there is no uncertainty. It is the average of all the incomes that a household is anticipating with large amount of certainty in the long run. It can also be called the opposite of transitory income, which is a short-run income that is very surprising nature. Any windfall income is an example of transitory income. Income of a household consists of both permanent and transitory income. Typical nature of transitory income is that gains and loss of this cancels out in the long run. For example, households can receive transitory incomes through lottery wins, bonuses, and gifts from the relatives, and so on. They also face loss of transitory income due to sickness, accidents, unforeseen incidents, gifts that they pay to their relatives, and so on. These receipt and payment cancel out each other in the long run. Therefore, according to permanent income hypothesis, it is the permanent income that decides the consumption, and further, this hypothesis assumes no correlation between permanent and transitory incomes. The basic properties of the permanent income theory are the following. First, a proportion of permanent income is devoted towards permanent consumption, and this proportion is determined by demographic and ethnic factors, interest rate, and components of permanent income. Second, income consists of permanent income and transitory income. Third, consumption is the sum total of permanent consumption and transitory consumption. Fourth, there is no relationship between permanent income and transitory income. Fifth, there is no relationship between permanent consumption and transitory consumption. And the last property of this theory is that there is no relationship between transitory income and transitory consumption. The next theory of consumption is the life cycle theory of consumption. Although this theory is credited to Ando and Modigliani, the origin of this idea can be traced back to Sir Irving Fisher. Fisher was the first who observed that rational consumers make intertemporal choices of consumption, that is, consumption in different time periods are dependent upon each other. There is a trade-off between current and future consumption, meaning the more the consumption today, the less would be the consumption tomorrow. Fisher also pointed out that consumption depends not upon current or permanent income but on income over lifetime. That is how this theory is different from earlier theories of consumption that we discussed. Ando and Modigliani borrowed this idea and formulated life cycle hypothesis in 1960s. According to this hypothesis, an individual's lifetime consumption equals his or her lifetime income, and there is no relationship between current income and current consumption. People in times of higher income after meeting their consumption save more, and in times of low income, particularly after retirement, to maintain their earlier consumption or earlier standard of living, dissave. Thereby, people over their lifetime maintain a steady level of consumption. The hypothesis states three determinants of individual consumption in any time, and they are resources available to the individual, the rate of return on his capital, and the age of the individual. Next consumption theory is the Robert Hall's random walk theory. In all the previous theories that we have discussed so far, particularly in life cycle theory and permanent income theory, there is no uncertainty with regard to the future income. Robert E. Hall based his theory on this flaw of earlier theories by incorporating the uncertainty of income to life cycle and permanent income hypothesis. That is why this theory is also known as consumption theory under uncertainty. Some also call this theory as modern life cycle and permanent income hypothesis. It is in this theory Hall applied the theory of rational expectations. According to this, expected value of consumption is not observable. However, Hall said observed consumption behavior in period t+1 depends upon consumption in the previous period t and the unexpected element of consumption. Accordingly, it can be written as the equation of random walk theory can be written as Ct+1 is equal to Ct plus epsilon, where Ct+1 is consumption in period t+1, Ct is consumption in period t, and epsilon is expected consumption due to unexpected rise in income. So up to now, we have discussed one important macroeconomic variable, that is consumption. The next important variable that we will discuss is investment. Investment as a variable plays a very crucial role in the progress of an economy. The level of economic activity in an economy is largely determined by the level of investment. When the level of investment is very low, there is an all-round pessimistic environment. That means when there is this low level of investment, producers feel very pessimistic. That is why investors would not be coming forward to invest their money on the producing sector. So that is why the investment level would be very low in an economy where there is all-round pessimistic environment. And when the investments are very high, or there are high levels of investment in the economy, there is a chance of boom or most definitely optimistic environment inside the economy. Now, investment in the national income accounting means three things. First one is investment in plants, machineries, etc., which is broadly called business investment. Second one is investment by people for residential buildings, which is broadly called residential investments. And the third type of investment is the investment by business persons or on building inventories. We will focus on the first type of investment because various important issues of investment theories and investment decisions are based on this interpretation of investment. So we will for the moment kind of substitute the investment with the first meaning of investment that we had just discussed. Investment means spending money on anything with a purpose to yield a return. But when it comes to business investment, it means investment on physical and or financial assets for the purpose of making profit. To economists, investment usually means building stock of capital. In the term stock of capital, capital means machinery and equipment, land, building and inventories. Therefore, there is a difference between capital and investment. Further, whereas capital is a stock concept, investment is a flow concept. Investment can be of two types. One is gross investment, other one is net investment. Gross investment is the total change in capital goods per unit of time, normally 1 year. Net investment is the real or actual change in capital goods per unit of time. It is gross investment minus depreciation, where depreciation is the part of capital goods which cannot be used further in the process of production. So, net investment is gross investment minus depreciation. On the basis of determinants of investment, it is further divided into two types. That is, investment is further divided into two types. One is autonomous investment, another one is induced investment. Investment that is a function of income and interest rate only is called induced investment. It is positively related to income and negatively related to interest rate. Investment that is determined by the factors other than the level of income and interest rate is known as autonomous investment. These other factors are also called exogenous factors, whose examples are discovery of new markets, higher demand, population growth, optimistic environment in the economy, and so on. The question that we will take up now is a very fundamental question of how an investment decision is made. There are two important methods by which firms make investment decisions. First one is the net present value method or NPV method. Whenever an investment is made on a project, revenue from that project is expected to come in each year after a gestation period over the entire lifespan of that project. According to the NPV method, investment decisions are made on the basis of the difference between present value of all the incomes to be accrued in future and cost of investment. Then, how can you calculate the present value of income streams? Present value of income is nothing but the discounted value of future income at the market rate of interest under assumption of constant prices. The discount of future income is based on the time theory value, which states that 1 rupee today is preferable to that same 1 rupee at some future date. The formula for present value is equal to future value upon 1 plus the rate of interest whole to the power number of years, or we say future value upon 1 plus rate of interest whole to the power n, where n represents number of years, and this we take the power of the whole denominator only. Given the calculation method of net present value, a project is worth investment if NPV is greater than 0. In the case where NPV is less than 0, investment is not made. The optimum level of investment is reached when NPV is equal to 0. The second method is marginal efficiency of capital method. The marginal efficiency of capital method of taking investment decisions was given by John Maynard Keynes and is otherwise known as internal rate of return method. Keynes defined marginal efficiency of capital as that rate of discount which makes the present value of the series of annuities given by returns expected from the capital asset during its life just equal to its supply price. Simply put, MEC or marginal efficiency of capital is the rate that equals the discounted present value of series of expected future incomes with the cost of capital. Investment project is accepted or cleared if MEC is greater than market rate of interest. If MEC is equal to market rate of interest, investment is accepted only on non-profit considerations. If MEC is less than market rate of interest, then investment is rejected. The difference between MEC and MEI is that whereas MEC links investment demand of an individual firm with the interest rate, MEI or marginal efficiency of investment links the investment demand of all the firms with the interest rate. Note here, whereas in the former case it was the individual firm's investment demand, in the case of marginal efficiency of investment, it is the investment demand for all the firms or of the economy as a whole. MEI schedule is also otherwise interpreted as investment function, which is written as I is equal to F function of small I, that is small I here is interest rate, capital I is the investment. The accelerator theory of investment is based upon the idea that investment is related to income. More precisely, acceleration principle states that the size of the optimum stock of capital is decided by the level of output. This theory describes the technological relationship between the changes in capital stock and the changes in the level of output. Tobin's Q theory of investment was developed by James Tobin, who acknowledged the reality that a large portion of investment in a firm is raised from the capital market along with money market. This reality is incorporated in this theory, and that is why it is separate from the other theories. Here, investment is decided by the share price of a firm, which is determined in the stock market. Price of a share in a company represents the shareholders' claim in that company, and therefore, when share prices go up, value of the shareholders' asset go up, resulting in a higher investment. The higher the share price, the higher is the investment. Since share price of a company depends upon the realized profits and expected future profit of the company, when share price rise, it is an indication of more opportunities for investment. Tobin's concept of Q is measured by the formula market value of installed capital upon replacement cost of installed capital, or Q is equal to market value of installed capital upon replacement cost of installed capital. Here, installed capital means the existing capital that is created in the company, and market value of this is derived by multiplying the market price, that is this share price. This is nothing but the market capitalization of the company in the stock market, or simply value of the company in the stock market. The denominator of this formula is the price to be paid to replace the depreciated capital of the company. Therefore, Q is the ratio of market value of the company to its replacement cost, and on the basis of Q, investment decisions are made. That is what James Tobin told us. There is an increase in investment in the stock of capital if Q is greater than 1. There is a standstill or decrease in investment when Q is less than equal to 1. Or when Q is equal to 1, we interpret as firms are reluctant to replace their depreciated capital. So students, let us summarize this module. In this module, we dealt with two very important macroeconomic variables, namely consumption and investment in detail. With the help of various theories of consumption, we tried to analyze the main determinants of it and saw how the very concept of income changes from absolute to relative to permanent income in all those theories. Also, we discussed the role of unexpected change in income on consumption through Robert Hall's theory. Similar kind of analysis is done on investment. We discussed various types of investment, from gross and net investment to autonomous and induced investment. The question of how investment decision is made was tackled with the help of net present value method and marginal efficiency of capital method. We finished this module with the analysis of accelerator theory of investment, or which is famously known as Q theory of investment.